All right, let's talk about one of the most powerful and, most controversial tools in all of modern finance, the credit default swap. Yeah, it was right at the center of the 2008 financial crisis, but what is it really and how does it even work? So, just imagine for a second that you're a bank. You've just loaned a huge company millions of dollars. Your biggest worry is pretty simple, right? What happens if that company can't pay you back? Well, that's the fundamental problem every lender has to deal with, and it's the exact problem the credit default swap was created to solve. And this is where the CDS comes into play. The easiest way to think about it is like an insurance policy, but for debt. It's a private contract where a buyer pays a regular fee, a premium. In exchange, the seller promises to cover the loss if something bad, what's called a credit event, actually happens. Like the company going bankrupt or just flat out failing to make a payment. So, how does one of these things actually work in practice? To really get it, we need to break down who the key players are and how the money flows. Okay, so every single CDS deal has three main parties. First, you've got the protection buyer. That's our bank from the first example, the one looking to get rid of its risk. Then you have the protection seller, maybe an investment fund who's willing to take on that risk in exchange for a fee. And finally, there's the reference entity. That's the company whose debt is basically being insured. The whole process starts pretty simply. The protection buyer makes these regular payments, called the CDS spread, to the seller. Seriously, think of it just like paying your premium for car insurance or home insurance. It's the cost of having that safety net in place. So, what is it that actually triggers the payout? I mean, for most of its life, the contract just sits there, it's dormant, but it snaps into action the second that the reference entity has one of these predefined credit events, which is just a fancy way of saying it's in deep financial trouble. And boom, here comes the payout. Once that credit event happens, the protection seller has to step in and pay the buyer to cover the loss on that bad debt. And just like that, the risk has been passed from one party to another. Pretty clever, right? This all leads to a really critical question. How do you actually price this kind of risk? I mean, what determines the premium that the protection buyer has to pay? Look, while the actual financial models are, believe me, incredibly complex, the core idea is pretty straightforward. The price you pay for protection, that CDS spread, it really boils down to two things. How likely is it that the company will default? And if it does, how much money is going to be lost? The riskier the company, the higher the premium. Simple as that. Okay, and this brings us to the real heart of why these things are so fascinating and also so controversial. A CDS can be used for two totally different, almost opposite reasons. So on one hand, a CDS is an amazing risk management tool. A bank holding a ton of a company's bonds can buy a CDS to hedge or insure their investment. It's just like buying fire insurance on a house you own. But, and this is a huge but, on the other hand, you can buy a CDS without owning any of the company's debt at all. This is what's called a naked CDS, and it's a pure bet. You're speculating that the company is going to get into trouble. It's basically like buying fire insurance on your neighbor's house because you think it might burn down. And of course, the market didn't just stop with single companies. Oh no. Index CDS were created to let investors hedge or bet on the credit risk of whole groups of companies at once. Like the entire high-yield bond market or a basket of European banks. This just scales up both the hedging and the betting possibilities to a massive degree. So let's zoom out a bit. What happens when you have literally trillions of dollars of these instruments flying around the globe? What's the bigger impact on the whole financial system? Well, at its core, the main job of the CDS market is to move risk around the system. So a bank that has way too much exposure to, say, the auto industry can use a CDS to transfer that risk to an investment fund that actually wants to take it on. In theory, this is supposed to make the whole system more stable by spreading that risk out. And that, right there, is the fundamental question that hangs over this entire market. The ability to transfer risk is incredibly powerful, no doubt. But it also creates a brand new kind of danger. What happens if all that risk, now totally separated from the original loans and bonds, ends up getting concentrated in just a few places, totally hidden from regulators? It's a tool that can spread danger out, or it can silently build it up into the exact kind of systemic crisis we saw back in 2008.